HomeOne. So we are really excited about this. This is all about education, raising awareness, because realtors are a very, very important part of the affordable ecosystem. You're at the front line, of the transaction. I call it the genesis of the transaction. It really starts with you, the loan originators and housing counselors out there. So it's really important to make sure that the home buying journey is a good one for these first-time home buyers and also repeat home buyers. So without further ado, I'm going to turn it over to my friend Brian and sit back and enjoy. There's going to be a lot of great information, and Matt Lafferty will be giving you a copy of these presentations so you don't have to jot everything down. So again, thank you for being with us, and Brian, it's all yours.
All right, thank you so much, Jim, and thank you, everyone. Jim, can you just confirm, are you seeing my deck here?
Yes. Yeah.
All right,
absolutely.
Fantastic. So thank you so much for having me. I'm very happy, and we're very happy at Freddie Mac to be partnering with the Delaware Association of Realtors to really be bringing you kind of information and tools that you kind of have at your disposal to really be those trusted advisors that your clients are looking for. And we really want to share this information with you about 2 low down payment offerings that we have here at Freddie Mac, and those are our HomePossible and HomeOne mortgage offerings. And throughout the session, we'll take a look at how these can really benefit your clients in being able to qualifying for purchasing a home as we kind of go through the session, and also taking a look at what some of the difference are with both of the options. So as you heard, my name is Brian Scholes, and I am a national trainer here in the Customer Education Department at Freddie Mac. And please make sure that you are communicating with us for any questions that you might have. I do have my chat window open, so please feel free to type those into the text chat, and we will hopefully answer all of your questions here on today's session. So when we are thinking about the state of the purchase market, in a study that was conducted by the National Association of Realtors, really took a look at some generational trends in a report that they conducted in 2020. And what we saw was that about 30% of your clients who are in the purchasing market are considered first-time home buyers. We here at Freddie Mac define a first-time home buyer as a borrower who's never had any ownership interest in residential property or hasn't had any ownership interest within the last 3 years. Now with that, 52% of buyers are in the age about 30 to 39 years, and 88% of buyers are 29 years and younger. Now, as we think about, the different generations, when we're looking at, younger adults coming into the purchase market, about 38% do fall into that millennial generation. But really, in looking and talking with those individuals, what we found was that, their challenge is really no different than what preceded them when we're thinking about generations. And really that major obstacle and that major barrier for home ownership is really that ability to really save for that down payment. That still continues to be the major obstacle. Now, we are still seeing Gen Y, come into the purchase market with about 40% of Gen Y clients at first-time home buyers as well. Now, in thinking about this, and when thinking about, that barrier towards home ownership being the ability to save for the down payment, in studies that were conducted, what we found was that there really is a lack of knowledge out in the marketplace as to what lenders are requiring your clients to bring to the closing table. And in a recent survey, 44% felt that they weren't aware of any low down payment options, and 40% weren't aware of what lenders were requiring for them to bring to the closing table. And in a recent survey conducted by Freddie Mac, what we found is that we surveyed renters who were looking to purchase a property within the next 3 years. And 1/3 of those that were surveyed felt that lenders were still looking for 20% to bring to that closing table. And with that 20% in mind of those that were surveyed, and keep in mind, these are renters who were looking to purchase a home within the next 3 years. If 20% was a required down payment, 70% of those surveyed felt that it would further delay them from being able to purchase a home, maybe even extending it out to an additional 3 years. So we're looking at 6, maybe even 7 years before they would be eligible to purchase a home. And the remaining 30% felt that they would never be able to afford a home if 20% was the required down payment. So actually what I'm going to do here is, I just want to make sure, okay, I do. So I do have a video that I do want to play for you, and it's out on our website. And this is actually just a video that really kind of takes a look at borrowers who did utilize the HomePossible option in qualifying for a transaction.
Hi, I'm Christine Dolan, and I'm 24 years old, and I teach 2nd grade.
My name is Willie Dolan. I am 25 years old, and I am a tech entrepreneur. We both grew up in Oregon, and it was really important to us to find a home that was close to where our families were so that we could continue to build a community.
When we first got married, we were living in an apartment, and we just had so many problems with our apartments. We've had really bad luck. We knew that we wanted to get into a house as soon as we could, but it took us a while to get there just because of our finances and just our desire to find the right house.
The Dolans came to me because they were looking to buy their first house, and they had limited funds, and they had a very specific payment that they felt comfortable with. We ended up using the HomePossible because it's a 3% down, gave them a good rate, and it gave them the payment they felt good with, so I pre-approved them, and then they went out and found a home.
It was so scary because no one in our life has a house really that is our age, and so we knew we were taking a huge leap of faith because we didn't hear those positive experiences from our peers.
I love to sing, and when we lived in an apartment, I was always thinking about who's upstairs listening. But the first time I got to really belt out a note in my home, I could tell that this home was for me.
My name is Karina Segovia. I'm a real estate agent, and I am a proud homeowner. I moved from Mexico. I was born and raised there. My first language is Spanish. And I moved here when I was 15. I came here to work. Before I moved here, I rented a studio in the back of my sister's house. And it was very small. I went to see Sergio, which is the lender. I said, you know what, I'm interested in buying a house, but I have no credit. He said, why don't we check your credit right now? And the credit came back at 727. I was full of joy that my credit was so high.
The HomePossible is a great program that gives clients like Karina the opportunity to purchase a home with favorable terms and other products. To put someone like Karina in a home is a very rewarding experience. And I've helped some of her clients obtain homes, and for me, it's an honor to help her get her own home.
My name is Salome Williams. I work for Lowe's Home Improvement. I'm a honest, committed type of person, and I like things in order. I was born and raised in New Orleans. I'm originally from here. I've never left. Even after the storm, I stayed. I had a house before this. I went through foreclosure with that house. But at the time that I had the house before this, I just wasn't ready. When you take and you buy a home, you have to be prepared and you have to be ready.
So when Stella came to me, her situation, the property that she was purchasing, the location, everything about her made sense. So this product really made sense. So I gave her options. I gave her a comparison of what product we could make available to her. And of course, the HomePossible was the best option out there.
When you're talking about a home, you're talking about something that's originally something that's yours, something you can, when you walk through that door, it's like everything to you. The first morning, believe it or not, I took a cup of coffee and I sat on my carport and I just looked around and I just started crying because I'm like, wow, I did this. And it was a great feeling. I'm like, unreal. It was unreal.
So that really is, a neat little video. Let me just figure out how to get back to, there we go.
Hi, I'm Christine Dolan, and I'm 24 years old, and I teach second.
All right, Jim, can you confirm that you're just seeing my screen again? Presentation?
Yes, Brian, I see your presentation.
All right, fantastic. So with that, when we think about HomePossible, that is really a way for your clients to really qualify for that mortgage transaction with really bringing as low as 3% into the transaction. Because what HomePossible allows is, as you kind of heard about that video, when those clients were, those borrowers were looking for, being able to qualify but not really having that 20% saved for that down payment. HomePossible allows for your clients to qualify up to a 97% loan to value and a total loan to value of 105% with a qualifying affordable second. And what that qualifying affordable second is it's a form of secondary financing. And we will talk a little bit more about that a little bit later on in today's session. But always keep that in mind, because that is an option that they have available to them, to where they might be able to get some additional financing. And with that affordable second, they'll be able to qualify up to 105% total loan to value. Now, with HomePossible, when we're thinking about, loans that do tend to have higher loan to values, lenders are going to require that, your clients do obtain mortgage insurance on those loans. But some of the benefits with HomePossible, when you're comparing it to some other affordable offerings out there with FHA, where HomePossible really competitive. HomePossible, your clients are going to be able to qualify with reduced mortgage insurance coverage. And the standard coverage on a loan with an LTV greater than 95% is 35% coverage. But underneath HomePossible, when the LTVs exceed 95%, the required amount of mortgage insurance coverage your clients would have to obtain is 25%. So there's a 10% reduction, and that's really just a benefit that I want you to be aware of by utilizing HomePossible on their monthly housing payment. A couple of other things to keep into consideration is that underneath HomePossible, mortgage insurance is eligible to be canceled, where with FHA, there is an upfront fee. And not only is there that upfront fee, but that mortgage insurance stays in place for the life of the loan. So the borrower is paying that mortgage insurance premium for 25, 30 years, where underneath HomePossible, mortgage insurance is eligible to be canceled when your client's loan to value falls below 80%. On average, that occurs around year 7. Now, give or take a year or two, but on average, it occurs around year 7. So the borrower's only paying that mortgage insurance for 7 years compared to an additional maybe 23 years underneath an FHA offering. So what that means is, with more funds applied toward the principal upfront, a HomePossible mortgage with PMI really does let your client build equity faster in the property that they are looking to purchase. Now, in addition to that affordable second that I mentioned, HomePossible does allow your clients to utilize flexible sources of funds. A couple of flexible sources of funds that are only going to be eligible on the HomePossible offering is going to be cash on hand. And what cash on hand allows is when we think about borrowers who have low to moderate income, a lot of times they're not heavy users of credit. As you kind of heard in that video, the one lady was shocked to see that her credit score was 727 because she didn't utilize credit a lot. And when we're thinking about borrowers who have low to moderate income, a lot of times they're not heavy users of credit. And a lot of times they don't have any type of checkings or savings accounts. So HomePossible does allow for your clients to utilize cash on hand, cash that they might have been saved. Sometimes you might have heard this referred to as, mattress money or coffee can money. But there are certain requirements to that cash on hand, such as, they can't be heavy users of credit. Their credit report has to show 3 trade lines or less. They have to document their ability to be able to save the required funds for closing, and they can't have any type of checking or savings accounts. So that is an option. It also allows for those affordable seconds and sweat equity. And I want you to be aware of sweat equity because it is an eligible source of funds. And when you are, being that trust advisor and you are having that conversation with your clients, especially if you are talking to them about HomePossible, what sweat equity allows, it allows for your clients to be able to complete repairs on their own to the property that they might be looking to purchase. Now, it's a little nuanced as there does have to be kind of agreements in place between the seller and your client that allows them to complete those repairs. And as long as those repairs are completed in a workmanlike manner, whatever the amount of those repairs are and whatever value is given to those repairs, your clients can actually utilize that amount towards the funds that they need to bring to the closing table. Now, again, there is kind of a few more requirements towards that sweat equity that need to be met. That would always be a conversation that your clients would need to have with the lender that they are working with to really kind of see to make sure that they are meeting those requirements. But that is an eligible option. So if you do have a client who's very handy, I myself am not. My wife won't even let me paint a wall in our house. But if you do have, clients who are very handy, that becomes an eligible option as well. Now, with HomePossible, and this is really where HomePossible differs from HomeOne, is that HomePossible is our affordable offering. And it is designed to really assist those borrowers who have low to moderate income. So your clients need to meet certain income requirements. And in order to be eligible, their qualifying income cannot exceed 80% of the area median income for where the property is located. So, if you are familiar, and we'll take a look at the tool that I have available for you a little bit later on in today's session. But we do have a income, it's called our HomePossible Property and Eligibility tool. It's out on our website. You can access it by clicking on the link you do see here on this slide. All of the links, including the one that I just played for that video, are all active links throughout the deck. So you can always open the PDF of the deck that is being shared with you. You might come to the screen, you might need to hold down Control on your laptop to be able to access the link, but then you can always click on it, excuse me, to be taken out to that respective resource. Once you are on the tool, you just want to make sure that you enter in a full property address, and the results of that specific property will be returned to you, letting you know what that area median income limit requirement is. And then your client's qualifying income would need to be at or below 80% of that area median income. When we're thinking about lenders and how they determine qualifying income, we always let them know that when it comes to meeting that 80% area median income requirement, that they just need to consider your client's true qualifying income. So your client's salary, if that is eligible to qualify them, that is all they need to take into consideration. In some instances, your clients might have some additional income, such as maybe commission, bonus, overtime. If that additional income is not needed to qualify, lenders don't need to take it into consideration when meeting these 80% area median income requirements for HomePossible. And that is why we always do, urge them to always think about that it's only your client's true qualifying income that needs to be taken into consideration. So when you are having that conversation with your clients, always keep that in mind, as well as you start talking about, what they might be eligible for, what they're really looking at, to always have that kind of in your back pocket to utilize that as a tool when looking to utilize HomePossible. Now, one thing to keep in mind too is, as you are having that conversation with your clients, is that HomePossible does allow for your clients to have additional ownership interests in residential property. So if you have a client who might be excuse me, selling a home, and maybe the sale of that home might not occur. Maybe they haven't found a purchaser yet, so it might not occur until after they close on the property they're looking to purchase, or maybe they might be looking to convert it into a rental property. That is eligible for HomePossible. So always keep that in mind as well. When you are thinking about that, because HomePossible does allow the borrower to have additional ownership, but at the time the borrower closes on that property that they're looking to purchase utilizing HomePossible, they cannot own more than 2 residential properties at the time they're closing on that property that they're looking to utilize HomePossible on. HomePossible also allows your clients to utilize a non-occupying borrower. And what a non-occupying borrower is when we think about borrowers who might have low to moderate income and why they would want to utilize one, we always want to keep that in mind, because HomePossible does allow for a non-occupying borrower, but at least one borrower must occupy that property as their primary residence. And let me open this up to you. Why do you think there would be some reasons for your client to add a non-occupying borrower? Utilizing that text chat, let me know. Why do you think? Any thoughts? What are some reasons you might think of that your client might want to utilize a non-occupying borrower? All right, let's take a look. So, one reason they might want to add a non-occupying borrower is to add some additional income. Maybe their income that they're utilizing to qualify isn't really enough to qualify them for the mortgage transaction. So they might want to utilize that non-occupying borrower to bring in some additional income. I do want you to keep in mind that if a non-occupying borrower's income is being utilized to qualify, then that income does need to be taken into consideration when meeting those area median incomes. It could also be to help improve a credit file. When we're thinking about borrowers who have low to moderate income, as we saw in that video, they might not be heavy users of credit, so it might be to help improve that credit profile for being eligible to qualify for that mortgage transaction. Or it can also be simply to include additional funds. So one of the things when utilizing a non-occupying borrower is that we don't have any specific requirements as to whose funds can be utilized when qualifying for that mortgage transaction underneath HomePossible. So it could be that, they might want to tap into some additional funds that the non-occupying borrower is eligible to bring to the closing table, and that all of the non-occupying borrower's funds can be utilized when qualifying for that HomePossible transaction. So those are a couple of reasons why, your clients might want to consider it. So again, when you are having that conversation and, they're saying, well, I'm not really sure if my credit's strong enough, I'm just starting to really look. I haven't really gotten the, full details about, being eligible. They're just kind of starting to look around. These are all things to keep in mind to really be that trusted advisor to have that conversations with your clients. Now, as I mentioned at the top of the session, HomePossible does allow for your clients to utilize an affordable second. An affordable second is a form of subsidiary secondary financing that allows your clients to qualify up to 105% total loan to value. Now, with an affordable second, it does need to come from an established and ongoing program. Sometimes you might see it come from a federal agency. You can see it come from a state municipality, some form of nonprofit organization, any type of faith-based groups. And on occasion, not very often, but on occasion, I have seen it come from your client's employers or maybe even their credit union. With an affordable second, sometimes this gets compared to a grant because there may or may not be a payment required on the affordable second. If there is a payment required on it, it might not start for a little bit later on down the road, maybe after 5 or 6 years. But if you are familiar with any down payment assistance programs within your footprints, within communities you service, the difference between an affordable second and a grant is that an affordable second is taken against the subject property and recorded in the land records, where a grant is not. So that is where lenders are then required to really take the amount of that affordable second and calculate that into the total loan to value up to that 105% max. Now, this is one of the requirements of our HomePossible offering, and we do require that that your clients go through home ownership education if all of your clients are first-time home buyers who are going to be qualifying for that mortgage transaction. And excuse me, as you kind of heard in that third example within that video, you heard that one lady speak about, like, she wasn't really prepared to own a home, right? She kind of went through a foreclosure because she wasn't really, aware of everything that went into it. And that's really where home ownership education comes into play, because it lets your clients know the kind of responsibility that goes into owning that home, how it's, financially, how it kind of prepares them for some maybe unforeseen events when it comes to like repairs or emergencies. And that is going to be required when all of your clients do meet that definition of a first-time home buyer. If any of you do to see any 2 to 4 unit properties where borrowers might be renting out one of the units within your footprints for the communities you service, we would require your clients to complete the Landlord Education program. And it's just important to remember that any education cannot be provided by an interested party to the transaction, the originating lender, or the seller. But as a great option to your clients is that we here at Freddie Mac actually offer the home ownership education through our Credit Smart platform. And with that, I'm actually going to turn this over to my colleague, Jim, who's going to talk a little bit more about the Credit Smart program for you guys.
Thank you, Brian. Great presentation so far. A lot of important information. And, one of the things that Freddie Mac prides itself in is, offering resources and tools to real estate professionals like yourselves and consumers. And everything that we provide is free of cost. So there's nothing being sold here. As I mentioned in the opening remarks, we're all in this together. And, with all the issues out in the market now with, lack of supply, high fair market values, making properties less affordable for the millennials and the first-time home buyers. you know, each transaction is that much more precious to us. You know, you know, we can't afford to really make any missteps. So the better educated that we are as professionals, you know, in the real estate industry, and the better educated that the consumer is, we all win. So, you know, Credit Smart, you know, is our program. It's a financial educational tool, and it's been around for 20 years. And, you know, we've enhanced it, you know, to move it forward, and it's all done online. And we mentioned earlier, you'll be getting a copy of this this presentation, so you'll be able to have the links that are on these slides available to you. You know, way back when I was in high school, you know, we were prepared for you know, budgeting and renting and home ownership, and those type of courses have gone away. You know, I saw it with my children when they went through high school, that those items weren't really being taught. And there's no shame in knowing what a debit and a credit is, and how to handle a bank account, and, you know, and to go further and you know, realize, you know, what you're going to need to do once you become a homeowner. You have to have that rainy day fund. So you have to be able to budget, because the water heater can go, the lawnmower can go, and you know, you need that cash to get these essential items to you know, make sure that your home is, you know, functioning properly. So Credit Smart, again, you know, it's an online educational tool. It has multiple modules. The consumer can do it on their own pace, and it's multilingual. And, you know, this is something that you can offer to your prospective home buyer as a tool that will really, you know, help them through the process. So, you know, your prospective home buyer, you know, I do know will greatly thank you for this, because things have changed out there, you know, especially in the millennial market. I mean, they are getting their information, you know, through YouTube, TikTok, I should say, and Instagram. It's not like it used to be. So, you know, once you are able to present them and, you know, an online educational tool, I think they will really, really appreciate it. So again, I mentioned there's 20 learning modules. They can do it on their own pace. You know, it helps them plan to save and prepare and protect their property. So, you know, great tool. And also there's a component in there specifically for home ownership. It's called Credit Smart Homebuyer U. And, you know, that has 6 learning modules. It's available in English and Spanish. And, you know, they get a certificate at the end. They have to pass the test. And let lenders throughout the country, you know, accept that certificate as you know, significance of that they passed a, you know, a certified educational home ownership educational course. So again, you know, great program. It's free. Please take advantage of it. Present it to your prospective home buyers. Next slide, please. And we also give you the opportunity to be a Credit Smart coach. So if you know, so if you want to be a leader in your community, you can go through our course. And we have you know, cohorts throughout the year to where you can become a certified facilitator to actually teach Credit Smart yourself. And you know, you can do this in your office, in your community centers, in your churches, you know, approach schools to see if, you know, they would allow you to come in and really prepare, you know, the prospective home buyers in your areas, by, you know, giving them a self-paced, you know, training. And it would allow you to interact, you know, with these young people who are, you know, thinking about, you know, the potential of buying a home. And again, like I said, it will put you in the spotlight in your communities, and it would really, you know, be a nice tool for you to put into your toolkit. And if any of you are interested in becoming a Credit Smart coach, please reach out to me. My email address is james_hall@freddiemac.com. Again, that's james_hall@freddiemac.com. And I can get you, in touch with the people that run the Credit Smart program here at Freddie Mac. And I think it would be, really worth your while, because, the prospective home buyers that go through this course, like I said earlier, they would remember you, and hopefully use your services when they do, go into the journey of purchasing a home. And then, of course, you do a good job for them, as we all know, you get referrals from that. So again, a great opportunity for you.
All right, thanks so much, Jim. And I also provided your email in the text chat for everyone, so they can always grab it from there as well.
Appreciate that, Brian.
So, absolutely. And Doreen had a question, thinking back on HomePossible with non-occupant borrowers, asking that, if a non-occupant borrower's income is being utilized to help the occupying borrower qualify for the mortgage transaction, then that non-occupant borrower's income does need to be taken into consideration when meeting that area median income requirement, to where both the non-occupant borrower and the occupying borrower's incomes would have to be 80% less or less than that area median income. All right. So now that's kind of a high overview of our HomePossible offering, but in the event that, your client's income might exceed 80% of the area median income for that specific geographical location, then we do have another option available to them, and that is our HomeOne offering. And with our HomeOne offering, this is eligible. Borrowers can still qualify up to a 97% loan to value, but there are no geographic or income limitations for a HomeOne mortgage. So if you're having that conversation and you're familiar with what maybe might be the area median income for that property your clients are looking to purchase, and you're having that conversation on what they might be eligible for, if their income exceeds that amount, that's where HomeOne then can come into play, because again, it still allows up to that 97%. So the borrowers or your clients still have to bring as little as 3% into the transaction, but there are no geographic or income limitations for a HomeOne transaction. Now, a couple of areas where HomeOne does differ from HomePossible is that at least one borrower must be one of your clients must be a first-time home buyer. So HomePossible, when you're thinking about HomePossible compared to HomeOne, HomePossible is eligible not only for first-time home buyers, but also repeat buyers. We saw where HomePossible does allow your clients to have additional ownership interests in residential property. They can still utilize HomePossible, but HomeOne does require at least one of your clients to meet that definition of a first-time home buyer, in the fact that it's your first time, your clients have never had any ownership interest in residential property, or they haven't had any residential ownership interest within the last 3 years. With HomeOne, all borrowers who are qualifying for the transaction must occupy that property as their primary residence. So whereas HomePossible does allow those non-occupying borrowers are not eligible on HomeOne, because all of your clients who are looking to purchase that property or qualifying for that mortgage transaction are going to need to reside in that property as their primary residence. As I mentioned, there are no income limits, so there are no specific area median income requirements that need to be met. There are no income limits. Homeownership education is still going to be required when all of your clients do meet that definition of a first-time home buyer. As Jim was speaking to, Credit Smart can still be utilized for both HomePossible and HomeOne. And then the other requirement here, and this is really from a lender perspective, but I just want you to be aware of it as well, is that with HomeOne, we do require lenders to submit those through Loan Product Advisor. If you're not familiar with Loan Product Advisor, that is our proprietary automated underwriting system. So we would require lenders to submit any of your clients who are looking to qualify for a HomeOne transaction through Loan Product Advisor and receive and accept risk class on those transactions. All right. So now this is where I am going to ask you to be at the ready, because we are going to go through a couple of scenarios, and I want you to just kind of respond to me in that text chat. So if everyone can make sure they do have their chat windows open, because we're going to walk through a couple of examples. So here we have two clients, okay, and they're coming to you and they're looking to purchase a home. And one of the clients is looking to upgrade their current property, and they currently own a home, but they're looking to sell that property, maybe to generate some funds to qualify for the new property that they're looking to purchase. Whereas your second client, these are newlyweds who are currently renting, and they have never had any ownership in residential property. So beginning with client one, which option do you think would be best suited for for these clients? Let me know in the text chat. All right, I'm seeing HomePossible. Anybody think otherwise? I'm saying possibly both. All right, let's take a look. So keep in mind that because they have ownership interest currently, they don't meet that definition of a first-time home buyer, where HomeOne does require your clients to be first-time home buyers. These clients do have additional ownership interests currently, so they would not meet that definition. So they would only be eligible to look at the HomePossible option. So in having that conversation with your clients, they let you know that their combined income is about $63,500. They're looking to purchase a property in Wilmington, and they sold their property, or they are selling their property, and the sale is going to occur prior to them closing on their new property, but they're still looking to tap into some additional funds. So here is that HomePossible property and eligibility tool. We're looking at a property located in 1600 Rockland Road in Wilmington. Is anybody familiar with this property? I think it is a famous landmark of some sort. So in looking, when you go out to the HomePossible property and eligibility tool, once you type in that address, you can see where the tool will return what the area median income is. So here you're looking at that 80% or less. So is the client's income eligible for HomePossible? Let me know in that text chat. Just give me a quick yes or no. Yeah, absolutely, right? It's below 80% of the area median income, so would be eligible because it is at or below 80% of the area median income. And are there any down payment assistance programs available to your clients? So the other reason I do want you to be aware of this tool is because within the tool, there is this link for down payment assistance. And this is a great resource for you, because if your clients are looking to tap into some additional funds, or maybe they're looking to, maybe they don't have the 20% that they feel is required by lenders, and they're looking to maybe utilize some down payment assistance funds, this tool, once you're out on the HomePossible property and eligibility tool, if you click on that down payment assistance links, it's going to bring up an additional page, and that additional page is going to ask you some additional questions, and you can always just have that conversation with your clients. It's going to ask, are they a first-time home buyer? What's their income? Are they a veteran? Does anybody who's qualifying for the mortgage transaction work in a specific field? how many people are going to be living in the property. And once you have that conversation and you do identify that with your clients, you can answer those questions. And what will happen is once you hit submit, it will return all of the down payment assistance programs that are available within that specific geographical location. If you want to learn more, you can always click on learn more. It will tell you what the qualifications are, how much your clients might be eligible to qualify for. So you can see some of these are, $5,000, 5% of the purchase price. Sometimes these down payment assistance programs have limited funds. So in the event that they are out of funds, that will notify you as well. So these are just really great options to where you can kind of see what's available within that specific geographical location. And that's another great way just to really be that trusted advisor that your clients are looking for. If they do have that conversation where they, they're kind of hemming and hawing and they're really not ready because they don't feel they have enough funds, this is a great option to where you can really have that conversation with them. Just let them know, like, well, let's see if there's any other, additional funds you might be able to tap into and what the requirements of those might be, because some of these might be forgivable grants or, grants. Some of these might be forgivable affordable seconds. You can always look into these down payment assistance programs to see if your clients might be able to utilize these. All right. So with that in mind, you were able to help your clients to get their dream home by utilizing HomePossible, looking at their qualifying income, helping them qualify with additional down payment assistance options that they had available to them to really get them into that dream home they were looking to purchase. All right. So what about client two? Circling back around to client two, which option would be best suited for this client? Remember, they are newlyweds who are currently renting and have never had any ownership interest in a property before. So would they be better suited for HomePossible, HomeOne, or both? All right, and I'm seeing it looks like majority of us are saying both, and you are indeed correct. Because they do meet that definition of a first-time home buyer, they would be eligible for both offerings. Now, in having that conversation with your second client, they let you know that their combined income is about $89,000. This property is located in Dover. They are first-time home buyers, but they really want to put about 3% down with that additional financing. So let's see. So here is the area median income for this specific geographical location. I believe this property is the First National Historic Park located in Dover, Wilmington. I'm not sure if anybody is familiar with this location, but do they qualify for HomePossible? Yes or no? What do you think? All right, so I'm seeing some yeses come in, and in this instance, in looking at that 80% of that area median income, which is $55,200, this client's income exceeds that area median income, so they would not be eligible for HomePossible because their qualifying income exceeded 80%. So then they still might be eligible for HomeOne provided all other requirements have been met. With that, do they have to complete the homeownership education in this instance? What do you think? Thinking back to the requirements of homeownership education, would they be required to complete it? All right, as I'm seeing those results come in, it looks like we're and yes, you're correct. If they are eligible, yeah, they would be required to complete the homeownership education. Keep in mind that we do require home ownership to be completed for both HomePossible and HomeOne. when your clients do meet that definition of a first-time home buyer, they would be required to complete that home ownership education, utilizing that Credit Smart Home Buyer U, which Jim spoke about. Keep in mind that those modules, that Credit Smart Home Buyer U tutorial with certificate is available in English and Spanish. And then once completed, they do have that homeownership education certificate that they can always provide directly to their lender, and their lender would have to retain that in the mortgage file. And there is a link for that Credit Smart Home Buyer U with certificate down there at the bottom of the slide that I have provided for you as well. And as always, keep in mind, as Jim pointed out as well, those are all active links throughout the presentation. All right, so congratulations, you have helped both clients secure their dream of home ownership by utilizing both our HomePossible and HomeOne offerings. You've also made client 2 more financially responsible by completing our home ownership education through our Freddie Mac Credit Smart Home Buyer U course, preparing them for the responsibility of owning a home. All right, fantastic, everyone. So with that, I'm actually going to turn this back over to my colleague, Jim, who is going to walk through some of our resources that we have available for you. So Jim, take it away.
All right, thank you, Brian. Hopefully you found that presentation exciting and informative. I know I did. It's always neat to be able to be challenged out there to see what you've learned throughout the presentation. So as Brian had mentioned on the property and income eligibility tool, down payment assistance is very important. So that down payment resource website, as he had illustrated, gives you opportunities to help the first-time home buyers, find monies for their down payment and closing costs, because we all know that that is one of the major hurdles that especially first-time home buyers have, is that they don't have a lot of cash assets. So that will put you ahead of your peers if you know where to direct them to get assistance for down payment. So the down payment resource website is a very important tool. I highly suggest that you you take a look at it, bookmark it, make sure that you have it in your favorites on your computer, so you'll be able to access it at and take minimum time to get to it. So again, recommend it to your prospective home buyers, so they can go out there and make the right choice for them if they need help with down payments. Next slide. Yes, let's talk about My Home. Okay, whereas down payment resource, that's a third-party company. My Home is a tool provided by Freddie Mac. It's a resource center. It's a website for consumers with important resources on renting, home buying, and the mortgage process. It's not a course like Credit Smart. This is just more of an informational type of website. So please, again, share these links with your prospective home buyers. They will really appreciate that you're there, counseling them through this process and giving them enough material and information so they can make one of the largest financial decisions of their lives. So again, great website. Check it out when we're done this call. It's myhome.freddie-mac.com, and it's really a great resource for the consumer to use, and a great tool for you to offer to your prospective clients. Next slide. Okay, HUD-approved counseling agencies are a very important part of the affordable ecosystem, and they also partner with Freddie Mac. So it's important that, again, this is another website that is a great tool for you. These counseling agencies work with lenders in minority and underserved communities. They serve 14 markets across the country. And again, they prepare prospective buyers for responsible home ownership, help struggling borrowers, avoid foreclosure. So it's not only for, your prospective clients, but it could be for a past client where, you've learned that, they are having trouble right now, maintaining the payments on their home, and they may be in danger of losing it. So if you could, again, be a trusted resource for them and counsel them through the process, that will, help them in the future, and hopefully they'll be able to regain footing and maintain the home. And then, somewhere down the line, they're looking to buy another property, they'll remember what you did for them, and come back to you and be a repeat client. Please advance the slide. And I encourage you to sign up for our Real Estate Professional Resource Center. This is where Freddie Mac will send you, periodic information, regarding the market, industry trends, key topics. We promise we will not spam you. Again, being a government-sponsored enterprise, we're here to help our business partners like yourselves, and keep you ahead of the curve. So, Freddie Mac prides itself in providing up-to-date information. And again, this will set you above your peers, in your communities, because, you'll be getting this, really, really valuable information, and be able to utilize it in your business development strategies. Please advance the slide. So with that, I'm going to ask Brian to come back on. If you have any questions, please utilize this time, and while you have us here, and really, really appreciate that you took the time to tune in today, and always appreciate Matt Lafferty's partnership and Delaware Association of Realtors. And Brian, you want to come back on?
Yeah, absolutely. So what questions do you have for us? And one thing that I want to do is excuse me, I want to see if I can kind of show you that down payment assistance tool. So please, any questions that you might have, type that into the text chat. So if you come out to freddiemac.com, and Jim, are you seeing the website? Okay. And you click on single family division, and you click on the working with us. There's this affordable lending underneath programs. So you want to click on that, and that's going to take you to where you can access the HomePossible eligibility tool. If you just kind of scroll down. So it's right here, the HomePossible income and property eligibility tool. And then once you click on that, that's going to bring up this map. And from here, you're just going to want to enter in the complete address. So I will use my address here in Illinois. Once you have that entered in, again, it'll return all of the area median income results. And then once you click on this link, it's going to take you to that down payment assistance page. As I mentioned, it's just going to ask you questions about your household. So I currently have 5 two-legged individuals living in my house and 2 four-legged. Do you currently own a home? We'll say no. So we'll say 72. So then it's going to ask, are you a former member of the, U.S. military? I am not. Thank you to any who are on who may have been. Are you American Indian? I am not. Do you are a co-borrower? So always keep in mind that this is going to be for your clients who are qualifying for the mortgage transaction. You might have instances where you might have a married couple, but you might only have one client qualifying for the mortgage transaction. So keep that in mind as well as you're answering these questions. My wife actually works in education, so I'm going to say yes. Does anyone living in the house have a disability? So always keep that in mind. You know, if in the event that someone's going to be living in the house does have a disability, you can always answer that as yes. But once you click on next, after you identify those, it will return all the programs that are available. As I mentioned, currently, so like here, down here, it will, if they do have limited funds, will identify if they are out of funds. But then once you are here, you can always just click on the learn more, and it will just kind of walk you through what the requirements are of that. You know, first it has to be a 30-year fixed. Excuse me. It is available for all, you know, first mortgage types. So always keep that in mind, because this really is a great property. If you know you do, if any of you do tend to see multi-unit properties, it will always tell you the requirements of any 2-unit properties, 3 units, so on and so forth. But this really is a great resource for you. So I did just want to highlight it briefly, just to kind of see. So you can see kind of how the tool works, and you can see what like some of the requirements are that you can always go out and verify.
Yeah, thank you for illustrating that, Brian. That was great. I saw a question from Naomi pop up in the chat box, if you want to address that.
Is the average for the locations based on median from lowest known and highest known income? So what it does is, when we're thinking about area median income, it's just, median is just the average income for that specific census tract, for that specific geographical location. So it does look at all of the incomes in that specific geographical location, and then derives at what that median income is based off all of the incomes within that specific census tract. And that's why, if you are really utilizing that tool, you always want to make sure that you do utilize a full property address. You could go out there and do a broader search, such as just typing in zip code or typing in a city. But what's going to happen is the tool is going to take you to the exact middle of that census tract. And within the broader area, there might be different area median income limits. So it'll give you, if you did zip code, it'll give you the area median income for the whole zip code within that census tract based off the exact center location. But once you start typing in the full property addresses, there might be different area median income pockets. So that's why I always urge you to always utilize a complete address. Does that answer your question, Naomi?
Okay.
All right, fantastic.
Great.
So any other questions?
Yeah, I don't see any in my chat.
I got none on my end either, Jim.
Okay, so if there's no more questions, Matt Lafferty, you'd like to come back on and close us out?
Sure. So thank you, Jim and Brian, for today's presentation. To all of our attendees, I'll be sending a follow-up email with a copy of today's presentation, as well as a link to register for next month's webinar. The fourth and final webinar in the series will be on June 8th at 10 a.m. and we'll discuss Freddie Mac's choice renovation and green choice mortgage solutions. If there's nothing else, thanks everybody for joining us. Have a good day.
Have a great day, everyone. Thanks for having us.
Thank you, everybody. Have a great day. Bye-bye.